Good to have you. We've already heard the bear case this hour. Jonathan, why are you feeling so bullish about the market next year in the face of lower estimates for GDP and concerns about Omicron and tightening from the Fed?
Well, first, if you look at next year's GDP numbers, the real GDP without inflation has been actually trailing off a bit recently. Most of that is because of Omicron, which is going to be short-lived. But if you look at the nominal GDP number, that's the one that includes inflation. That's the way that we measure earnings. It's going higher and is up to about 7.5% next year. And that's consensus expectations. And that's almost double what a normal year would look like. So our optimism is not that it's a perfect year, but one that earnings continue to deliver.
But what about the fading stimulus from the Fed, from the fiscal authorities? But both are in the mode of starting to withdraw that. And that could be a headwind for growth, but more importantly, maybe for the markets, because no matter how you look at the bullishness over the last 3 years, you have to factor in all the liquidity and the fact that the Fed's balance sheet is now over $8 trillion.
Well, yeah, Sarah, I agree with you, and I also disagree. If you take a look at last year, the earnings of companies in the S&P 500 grew faster than their price. You actually saw, as much as it doesn't feel that way, the PE multiple, the valuations on the stock market, fell over the last 12 months. And if you consider, look at where we were at this point last year. We had this, this new vaccine that was going to, do all these wonderful things. Inflation was less than 1.5%. There was no worry there. You fast forward, inflation is an issue. We have Omicron is an issue. You have this tightening that the Fed is driving. But ultimately, it was a great year in the face of all of that. And it's because of the simple fact that earnings delivered. Now, if you look at the economic data, it understands all of this. And economists are still projecting that we see, when I say all of this, it still, includes the fact that we're withdrawing some of this liquidity and the fact that there's a bit of a fiscal cliff coming with less stimulus. And yet economists are still forecasting over, something close to 7.5% nominal GDP, which is fantastic.